Hello everyone, this is Doc from the Wealth Boardroom. Welcome to the channel. Today we're going to dive into a topic that touches us all, our money and where we keep it. We'll be focusing on the Dodd-Frank policy, a piece of legislation that has far-reaching implications for consumer deposits. Now, you might be wondering, why should I care about some policy? Well, the answer is simple. This policy could directly impact your hard-earned savings. It's crucial to understand the risks associated with bank deposits and how to safeguard your financial stability. We'll also explore alternatives outside the traditional banking system and share strategies to help mitigate deposit risk. And because knowledge is power, we'll delve into why banks fail and the current indicators that a bank failure could be imminent. So, without further ado, let's delve into the world of banking policies and your money. First things first, it's important to understand what the Dodd-Frank policy is. It's a significant piece of legislation that was passed in the United States back in 2010 in response to the financial crisis of 2007-2008. Its full name, the Dodd-Frank Wall Street Reform and Consumer Protection Act, gives a hint about its broad scope and purpose: to prevent another financial crisis by promoting stability, transparency, and consumer protection in the financial system. At the heart of the Dodd-Frank policy are several key provisions that directly affect banks and their customers. One of these is the Volcker Rule, which restricts banks from making certain kinds of speculative investments that do not benefit their customers. This rule was designed to keep banks' risk-taking in check and protect consumers' deposits. Another significant provision is the creation of the Consumer Financial Protection Bureau, CFPB. This agency is tasked with protecting consumers from unfair, deceptive, or abusive practices in the financial sector. It oversees financial products and services, from mortgages to credit cards to student loans, ensuring that consumers have access to clear and accurate information. The Dodd-Frank policy also established new requirements for banks regarding capital and liquidity. Banks are now required to hold more capital to cover potential losses and to have enough high-quality liquid assets that can easily be sold in a crisis. These measures are designed to make banks more resilient and less likely to fail, which in turn protects consumers' deposits. Lastly, the Dodd-Frank policy introduced resolution planning, or living wills, for large banks. These plans outline how a bank would be safely wound down in the event of its failure, without causing a broader financial crisis. This provision is intended to prevent taxpayer-funded bailouts and to minimize the impact of a bank failure on its customers. Now that we've understood the basics of the Dodd-Frank policy, let's move on to its implications for consumer deposits. The Dodd-Frank policy has significant implications for consumer deposits. This sweeping financial reform legislation, passed in the wake of the global financial crisis, has a direct impact on our day-to-day banking activities. One key aspect of the Dodd-Frank policy that we need to focus on is the provisions related to bank resolution and bail-in mechanisms. Let's untangle these terms a bit. Bank resolution is the process through which a failing bank is either saved or shut down in an orderly manner. The idea is to minimize the impact on the economy and, most importantly, the bank's customers. Now, the bail-in mechanism is a tool that allows a failing bank to be recapitalized using the funds of its unsecured creditors, and unfortunately, that includes us, the depositors. So, how does this affect your deposits? Well, in a worst-case scenario, if a bank is on the verge of collapse, the bail-in mechanism could be activated. This means that instead of the government stepping in to bail out the bank using taxpayer money, as we saw during the financial crisis, the bank would use its own creditors' funds to stabilize itself. That's right. Your deposits could potentially be converted into equity to save the bank. This is where the safety of consumer deposits comes into question. Your money could be at risk if your bank is failing, and the bail-in mechanism is triggered. The Dodd-Frank policy, while designed to protect the economy from another financial crisis, places a new level of risk on the shoulders of consumers. But don't panic yet. There are safeguards in place. For instance, the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to $250,000. So, if your deposits are within this limit at an FDIC-insured bank, you're protected. So, you see, it's not just about the policy, but how it affects your hard-earned money. Let's now look at how you can safeguard it. There are several strategies you can employ to mitigate deposit risk. In an era where financial uncertainty seems to be the only certain thing, it's essential to safeguard your hard-earned cash savings. One of the most effective ways to do this is by exploring alternative options outside the traditional banking system. Consider this. Precious metals like gold and silver have been used as a form of currency for thousands of years and continue to hold intrinsic value. Investing a portion of your savings into precious metals can serve as a hedge against deposit risk, providing a safety net in times of financial instability. Another strategy is to venture into the world of digital currencies. Cryptocurrencies like Bitcoin and Ethereum have proven to be a viable alternative to traditional banking. While they come with their own set of risks, these digital assets can offer significant growth potential and are not tied to any government or central bank, making them immune to policies like Dodd-Frank. Peer-to-peer lending platforms can also be a viable alternative. These platforms allow you to lend your money directly to individuals or small businesses in return for interest payments. The risk here is managed by diversifying your loans across a wide range of borrowers, reducing the impact if any single loan defaults. Real estate is another avenue worth exploring. Investing in rental properties or real estate investment trusts, REITs, can provide a steady stream of income and serve as a tangible asset that appreciates over time. Lastly, consider keeping a portion of your cash savings in a home safe or a safety deposit box. While this strategy may seem old-fashioned, having immediate access to cash can be invaluable in times of crisis. These are just a few strategies to consider. The key is diversification, spreading your savings across a variety of assets and platforms to reduce risk and maximize potential returns. Remember, diversification is key when it comes to safeguarding your money. Now, it's essential to understand why banks fail and how you can spot the indicators of a failing bank. Banks, like any other business, can fail for a variety of reasons. The most common cause is that they have made too many poor investments or loans that borrowers cannot repay. This is often due to a downturn in the economy, where businesses and individuals struggle to meet their financial obligations. Banks also fail when they cannot meet their own financial obligations. They have to maintain a certain level of capital to cover potential losses. If a bank's capital levels drop too low, it can lead to insolvency. So, how can you spot the signs of a failing bank? There are several indicators you can look out for. Firstly, the bank's financial health. You can usually find this information in the bank's annual report. Look for a decline in profits or an increase in non-performing loans. These are loans where the borrower is not making interest payments or repaying any principal. Secondly, frequent changes in leadership can be a red flag. This could indicate internal problems or disagreements on how to run the bank. Thirdly, negative news or rumors about the bank. While not all rumors are true, they can be an indicator of potential problems. It's important to do your own research and not rely solely on rumors. Lastly, a sudden change in the bank's business model or strategy could be a sign of desperation. For instance, if a bank suddenly starts offering high interest rates to attract deposits, it may be because they are struggling to maintain their required capital levels. Remember, these are just indicators and not definitive proof of a failing bank. It's always a good idea to diversify your assets and not put all your eggs in one basket. In conclusion, spotting a failing bank can be tricky, but by staying informed about the financial health of your bank, looking out for signs of internal turmoil, and being aware of any negative news or drastic changes in business strategy, you can better protect your deposits. Stay vigilant, stay informed, and your money will stay safe. We've covered a lot in this video, from the Dodd-Frank policy to the risks associated with your bank deposits. We delved into the intricacies of the legislation and its potential implications for your hard-earned savings. We highlighted the bail-in mechanisms that may put your deposits at risk and the importance of staying informed about the financial health of your bank. We also explored strategies to mitigate deposit risk, from diversifying your assets to considering alternative options outside the traditional banking system. It's clear that understanding and managing these risks is crucial to maintaining your financial stability. Remember, the signs of a bank failure aren't always obvious, so it's essential to keep a keen eye on the indicators we discussed. With knowledge and a proactive approach, you can safeguard your assets and navigate the ever-changing financial landscape with confidence. That's it for today, folks. Don't forget to subscribe to our channel, The Wealth Boardroom, for more insights into the world of finance. Keep your money safe.